everybody. Welcome to the National Real Estate Post. We're here, of course, with Barry Habib. We'll get started in just a second. Before we do get started, I want to let you guys know Carl White and the Marketing Animals, they really are animals, aren't they, Barry? They're animals. They're animals. Anyway, they're really, really great, and they've got this webinar series that they want to get you guys connected with, where they're showing you how to not only use technology, but how to use that also combined with yourself. I mean, a lot of times technology gets you out of the picture, but that's really not how technology should be used, especially in the mortgage space. That's what we've been saying, and the Marketing Animals are right in line with us. But they want to show you guys some really cool stuff and how you can combine yourself with technology to make a big difference in your business. Click the banner you see here on your screen over on your right. You may have to scroll down on your mobile device to see it there. And if you're watching us on Facebook, there's a link around here somewhere. So with that, let's get right to the meat of the show. Barry Habib with us once again. Barry, how's it going?
I'm doing great, man. I'm doing really good. Excited to speak to you as always.
Yeah. So it looks like you redesigned your house just like a hotel room. That's really, really trippy.
I'm on the road today in Denver.
Yeah. Okay. So you're in Denver. Right on. Well, I hope they're enjoying whatever it is you're telling them. I'm sure it's great. So I wanted to talk to you about the recession. You know, there's in the past, in the not too different past, a lot of economists saying we're due. And if you look at history, it's like every 10 years or so, we have some sort of a recession. And we're going to like 12 years or so now or something like that. And we just, wanted to get your thoughts on it because we just really kind of hadn't seen it. And rates are still really low. And just, the economy seems to be doing good. Unemployment seems to be good. All the stuff that you're an expert at. So we thought we'd just ask you and get the update. What's the deal? What's going on? What are your thoughts?
A couple of things about recession. So it's not if there's going to be a recession, it's when. It's a cyclical economy. We are 10 years now, which is the longest period without a recession. So this is important because we certainly are due for one. What happens during recessions to real estate values? Believe it or not, real estate values tend to either stay flat or even go up in recessions. Why? Because during recessions, interest rates decline rather dramatically. So because of that combination, real estate tends to be someplace that's a good place to be. You also have great buying opportunities during recessions that occur. So knowing what happens during recession, knowing that interest rates decline, it also means that there's going to be great refinance opportunity for us. So think about your strategies today. If we think there's going to be a recession coming in 2020 or 2021, well, then you want to try and keep your upfront costs down. Include closing costs, take a higher rate. Don't pay upfront AMI. Don't pay points. These are good points of advice to give the customer. And then you mentioned, the unemployment rate. This is really great because while the inverted yield curve, meaning that longer term maturities are yielding less than shorter term maturities, that's the one everybody looks like. And it's important to see that because that's a great predictor of recessions, so long as that inversion stays place for a little bit of time. Now, here's what's interesting. When that happens and you start approaching a recession, the stock market tends to actually improve. Isn't that crazy? As you get closer to recession. But then when the recession hits, stocks can go down like 40 or 50%. So it'd be okay to stay in stocks, but as you get closer, you may want to be more conservative and cautious because recession causes prices. You can get real aggressive and say, I want to be short out of a recession. But listen, that's a whole different story. Now, with respect to how this affects yourself as someone who's giving advice, we talked about the fact that you want to give good advice. And we talked about the fact that the inverted yield curve is a great predictor, but the unemployment rate is an even better predictor. And not too many people know this, but you would think when the unemployment rate's high when you get into a recession, but it's actually when the unemployment rate is at its lowest level and then starts to turn higher. Think about it this way. Business is real good. I'm hiring people. Unemployment's low. Things are great. But then if there starts to see some weakness in the economy, well, I start to see a slowdown as an employer and have the unpleasant task of letting some people go. That increases the unemployment rate a little bit, but then the mindset of those people who are now unemployed is one where they're less apt to go out to dinners and buy, luxury items. So the stores that were depending on those people, they get slower. They let people go and the cycle begins to perpetuate itself. So we see the unemployment rate really shoot up during those periods of recession. And that's a great predictor. When you see the unemployment rate reach its bottom, and then start to move higher, that's a great predictor that 6 months later you'd see recession. Look for 4.1% on the unemployment rate. It's currently 3.8. If it hits above 4.1, I'd be careful and start thinking that about 6 months later you'd see a recession, which means lower rates, stocks maybe go up a little bit, but then can change course. So be careful about your investments and know that real estate remains good. Know that interest rates are going to be lower. Know that you can have opportunities for refinancing.
Good stuff, man. Great stuff. And so the nice thing, though, is we were kind of thinking we'd see rates a little bit higher than they are right now, and yet they've been great, and they still continue to do well. So then if we do move into this recessionary type of a period, then you could see even more improvement.
So, here's the thing that we've seen is that the Fed's backed off on hiking, but not so much backed off on hiking. They said that they were going to start reinvesting a bit in May and more in September. So the market loved the buying of bonds from the Fed. Okay.
Got it.
They backed off their hiking stance. They want to be more accommodative. But additionally, there is weakness in Europe. And you have to look at it this way. In Germany, the 10-year Bund is actually negative. So imagine this. You're giving them money for 10 years. Hold my money and wait a minute, I'm going to pay you. It's almost as if you're putting your furniture in storage you expect to pay for, but not my money in storage, right?
Yeah.
So even though our 10 year is yielding 2.5%, it looks so good. Foreign investors are flocking and purchasing our bonds, helping to keep rates lower. So because the globe is interconnected, we're the beneficiaries of weakness, even in Europe, where we're seeing yields lower.
Wow. Great stuff, Barry. Thanks so much. Guys, this has been good information that you can take and use. Absolutely. Love it, Barry. Thanks so much. We really appreciate you being on the show again.
Love you guys. Talk to you soon.
All right, you guys have a great one. Do us a favor. Leave us your comments down below. Barry, if he can get to it, he will. He is traveling, though, so bear with him. But also do us a favor, forward, share, and subscribe. And we'll catch you guys later here at the National Real Estate Post. See ya.